Hello everybody, I'm Joseph Khateri, a realtor in the state of Virginia, and today we're going through part 3 of our series, which is how to secure financing. We've already went through part 1, which was how to pick a city. We went through part 2, which was forming LLC, and now we're on to the money. Quick advisor, I'm not a CPA, I'm not a financial advisor, I'm not a lawyer. I'm just sharing what has worked with my investors, what has worked with me. Always consult a professional for your specific situation. All right, step 1, why saving matters. Now I know what some of you are probably thinking, Joseph, I thought this was how to invest with no money, little money, what's going on here? And you're right, you can invest with a minimal amount of cash. However, the more cash you have, the easier this process becomes. We're gonna go through this example on an $80,000 home. Obviously, if you're going for more expensive or cheaper, the figures are gonna change. But generally, on an 80K home with a 20% down payment, it's gonna be $16,000. Then you are a buyer in this scenario. And for buyer's agents, all you typically pay is some type of broker admin fee, usually $395 in the state of Virginia. Other states may differ, but I put $400. Then you're most likely going to do at least a home inspection and an appraisal, totaling about $1,000. And then when you're in this cheap of loans, we usually do flat rates for fees. So I typically see on an 80K home about $7,000 for closing costs. And then finally, rehab, that's really just however much it is. I don't know what kind of home you're going for. It could be turnkey, where you're going for, zero or close to it. Could be a full teardown. This rehab portion is really just going to be property dependent here. But just in case, I like to be conservative and put aside at least $4,000 for those random things that come up. For example, we invested in a house in Cleveland and it's a great place to invest. However, you need a lead paint certification. We did not know that at the time and that delayed us by a few months. So we ended up having to spend probably an extra $2,000 more than we wanted to. That's just an example. It's different in every scenario. You're going to make a mistake at some points where you probably should have an extra $4K buffer. So if you don't have that buffer, which I highly recommend, you're going to look at $24,400. Yes, that is a decent chunk of change. However, we're going to go ahead and show you how you can minimize that as much as humanly possible. Keep in mind though, probably at least 80% of you watching will end up going this route simply because it's the absolute easiest and absolute safest route you can go with investing in Section 8 housing. The less money you put down, typically the riskier it gets. All right, part 2, FHA loans, how to go in with as little as 3.5%. So, for those that don't know, FHA loans are a low down payment type of loan. You can put as low as 3.5% on a property, which is insanely low, especially when you're already considering these are, $80,000, $100,000, $150K homes. So let's look at that same $80,000 property. Your new down payment would be $2,800. The agent fees involved would be still the $400. Your inspection costs would also stay the same at about $1,000. For closing costs, fun fact, you can actually have the buyer's agent that I send you to negotiate these for you and have the seller potentially cover all of the closing costs. Or you can even talk to the lender involved and roll them into your loan. Now, a caveat there, this doesn't work with all properties. If you're in a hot market where people are doing full price asks, over asking price, homes are flying off the shelves in 3-4 days, then this probably won't work. And that rehab cost I mentioned earlier, well, if you're specifically looking at turnkey properties, that rehab cost could be $0. Now again, I still like to have a little buffer there, but that's technically optional. I highly recommend it. I never do a property without the buffer, but to each their own, I suppose. So if you're going with the absolute minimum I just mentioned, that'll bring your initial investment down to $4,200. That's less than 2 months of rent in most places. Now here are 3 requirements for FHA loans that a lot of people don't realize. So the first is you can't have purchased a home in the past 3 years. The second is that you must live at the property for at least 1 year. That must be your primary residence. Huge point there. Most of my clients who do FHA loans, they typically want to buy an investment that's close to where they already live because they're not comfortable buying out of state. So, for example, I had a client in Texas who bought a duplex for $160,000. They lived in one half of it and rented the other half to Section 8. Oh, and the third point, this is still a loan at the end of the day. You still have to qualify for it via credit score and income. You can't just go into this type of loan with a 400 credit score and making $500 a month. That won't qualify you. Pause. All right, let me go ahead and stop the video here because I have some announcements to make. The biggest being, and I know this is probably going to be a shock to a lot of you, that I launched a Section 8 mastery program. Now, I know what you're thinking, right? Oh, Joseph's the guy who's against courses and stuff like that, right? Well, the reason I made this is because I kept seeing these gurus with their Ferraris, right? Just blatantly giving wrong numbers, wrong figures to try to pull you in like a marketing tactic. They're giving outdated information, outdated statistics, and probably worst of all, none of them were even licensed. And overall, they're just selling you a dream that wouldn't work on the average beginning investor. I kept getting DMs from people saying like, hey, do you trust X person's course? And I say like, no. And they go buy it anyways. So what I did is I made a program that's actually good for beginner investors since you guys really were asking for it. And no, this isn't just some random like 5-part video on a random website. No, that's not what this is. While I do have content like that is going to be posted, I also have videos on how to find the best markets and direct market recommendations, passing HUD inspections, buying your first 2 or 3 properties and then scaling to over 10. And here's the key points: the ability to directly DM me and join a community of fellow investors doing the same strategy as you. Weekly group coaching sessions where I'm literally going to be coaching all of you live. And you can book one-on-one coaching meetings with me completely for free if you're in this program. So yeah, not one of those, I'm a guru and I'm selling you a course and then you buy it and you never hear from me. It's not that. I am literally going to be coaching you. Click the link in the description to enroll now. And you better do it quick because there's only a limited number of people that I can actually take on since I'm spending time with each of you. All right, now back to the video. All right, section 3, choosing the right loan. So I kind of already mentioned FHA, but we'll go through every option right now so to clear up any confusion. First up is conventional loans. It is best for those with 700 plus credit, at least $25,000 in cash, a steady income, a low debt to income ratio, and you can prove that you make money via tax returns. DSCR loans, debt service coverage ratio loans, are best for those who have at least a 660 credit score, at least $25,000 in cash, an LLC, some reserve funds, and you're okay with a little bit higher interest rate. I typically see on average DSCR to be about 1 to 1.5% higher than conventional loans. And that is the main reason why I don't just recommend DSCR to every single human. Sometimes you want a little bit lower interest and are okay doing the legwork. Forgot to mention, but with conventional loans, there are a few caveats here. So you may also be wondering, why doesn't everybody just go with conventional? That seems the best. Well, it's the best interest rate. However, you typically can't close under an LLC. You typically have to buy it in your personal name and then transfer. Sometimes that's not even allowed. They do check your tax returns and loan minimums. A lot of loan officers will say that you're not allowed to get a house under X dollars. For example, I believe with Chase, you can't get a home that's under $150,000. So you really want to check those loan minimums. With DSCR, you can go as low as $75K purchase price. We also have FHA loans, which was previously mentioned. You need at least a 580 credit score. You can go as low as 3.5% down payment as long as you have enough for closing costs as well. You have to live on the property for at least a year, and you still have to show tax returns to prove that you make a stable income. And finally, we have the last method that I do recommend, which is private money loans, aka the BRRRR strategy. This is best for experienced rehabbers that have a high cash reserve and a crazy high risk tolerance. I have an entire other video on what the BRRRR strategy is, so feel free to watch that instead, since I'm not really going to go into it right here. But it essentially means you use private money at a crazy interest rate, 12-13%, to buy a home in cash, rehab it, and all of a sudden now your appraisal value is a lot higher because it's now rehabbed, and then you refinance using some type of conventional or DSCR loan and pay back the private money loan. A lot more work, a lot more effort, a lot more risk, but potential for higher reward. Alright, and on to section 4, which is creative financing strategies that if you're just out of money, this is what you can do. So the first one needs money obviously, but it's all cash. This is the absolute best for super strong negotiations. A lot of the time, you might not need to go full asking price if you're an all cash offer. You might be able to knock a few thousand off because you know that that offer is strong. After you purchase in cash, you can rehab it, do a BRRRR, refinance into a DSCR or conventional, or just keep it all cash and take all of the profits to yourself. Another option is seller financing. No, do not do seller financing. I regret so badly recommending seller financing in that YouTube video I made like 2 years ago. It's just not possible. It really isn't possible in this market. The only time seller financing is somewhat possible is with $1 million businesses. These crazy commercial loans, because then seller financing might be the only choice. But for normal priced homes, it is not possible. These homes are flying off the shelves nowadays. Partially my fault, admittedly, for advertising this so much. Same with other investors such as Section 8 Kareem and Tom Cruise. By the way, you should not buy their courses. So these homes are flying off the shelves. There is no possible way you're going to do a seller financing. They're being bought in all cash. They're being bought over asking price by actual investors. So stay away from seller financing. It just does not work reliably. You're going to put in 10,000 text messages and get 5 replies. And of those 5, they're all going to be wanting 5-year, 10-year loans, not 30-year fixed loans. And finally, the last step is partnerships. Partner with someone who has a lot of capital. This one requires connections, of course, but you can partner with someone who has a lot of capital and just not enough knowledge or time to invest it themselves. For example, any doctor to ever exist, parents, close friends and family, etc. I typically don't actually recommend this route unless you typically have 5 to 10 homes under your belt already, so you're confident in your own skills that this will work. Because if you end up making a mistake, we all make mistakes, including myself. If you make a mistake in your first property, lose a lot of money, you're gonna lose their trust and their money and a potential friend. It's a lot more risky than you probably want in your first property. All right, and now on to section 5, which is getting pre-approved. So for traditional loans such as FHA and conventional, you're gonna wanna do, and I know it sucks, but basically cold calling. By this point, you should already have the city picked out. So let's say, for example, if you're choosing Birmingham, Alabama, you're gonna wanna just Google Birmingham, Alabama lenders. I just did it right here, and I don't really like Zillow, admittedly. So maybe we'll go on this next link, Wallet Hub. I mean, this seems like a fine website. I don't know anything about it. But there are a ton of banks here. You're just gonna cold call them and simply ask, hey, would I qualify? Might have to do a hard inquiry. Can I close under LLC? If not, when can I transfer? What are your loan minimums? Another good way to do it is simply just go on Google Maps and look up Birmingham, Alabama lenders and just start cold calling. I know that sucks, but there are so many lenders out there that I can't just give a direct recommendation for this. And another surefire way, in order to make sure you get a place that gives you loan minimums that you like, is make sure you just call the bank or lender that is absolute closest to the house you're looking at, or even just the area. Once you're pre-approved, you're pretty much ready for a realtor at that point. The thing I like about DSCR, again, is you can go as low as $75K purchase price. And if you guys are international, you guys are not based in the US, you can't get a conventional or FHA loan, you can do DSCR. There is going to be a bigger down payment, usually 25 to 35%, but it is possible at least. All right, so that's all I really have for you guys. If you like this video, please subscribe down below. You're also going to want to stay tuned for part 4, which should come out in a few weeks. As always, I'm Joseph Khateri, realtor in the state of Virginia. Subscribe for more and have a nice day.